Oil fell 2% in a single session, and Canadian savers cheered. That reaction tells you everything about how distorted this market has become. For 5 weeks, the Strait of Hormuz choke point had been functionally closed, cutting off roughly a fifth of global oil and LNG supply. Canada, as a major oil producer, had watched the price surge push input costs higher, while simultaneously threatening to force a central bank that was already holding at a 2.25% policy rate to pivot toward hikes. Then on Wednesday, President Trump told Reuters the U.S. war on Iran would end fairly soon. Oil dropped. The Canadian dollar strengthened 0.2% against the greenback. The TSX surged more than 300 points. Markets moved as if the crisis was resolved, but the strait is still not open, and forward oil contracts are still pricing in supply risk well above pre-war levels. The rally in equities masks a genuine policy trap that the Bank of Canada cannot escape cleanly. The March deliberations, released Wednesday, show Governing Council members explicitly debating two mutually exclusive responses to the same crisis. Higher oil prices drive cost-push inflation, the textbook case for rate hikes, but the same oil shock drags on manufacturing output. Canada's factory PMI fell to 50.0 in March, the lowest in 3 months, with new orders contracting to 48.7. The output subindex dipped below 50. That is the economic backdrop that usually calls for cuts, or at least a hold with a dovish lean. The BoC chose to wait. It kept rates at 2.25% on March 18th and said it would rely on judgment more heavily than usual. Forward contracts now price an 80% probability that the policy rate reaches 2.75% by December, a full 50 basis points higher. That pricing was built on the assumption of persistent oil-driven inflation. If Trump's peace signal holds and oil normalizes, that rate hike premium collapses. If the ceasefire stalls and oil climbs back toward $110, the BoC faces a scenario it has openly described as a dilemma: raising rates into a slowing manufacturing base against a backdrop of U.S. tariffs already hurting Canadian exports in autos, steel, and aluminum. The next decision date is April 29th. The BoC will release updated economic forecasts at the same time. Those forecasts will have to reconcile two scenarios that point in opposite directions.
While the market debate focuses on oil and rates, a quieter reorientation is underway at the government level, one that could prove more durable than either. Prime Minister Carney has been accelerating trade diversification since taking office, with Finance Minister Champagne traveling to China this week and Manulife and Sun Life CEOs meeting with a Chinese vice premier. Former Cabinet Minister Scott Brisson, writing in the Globe, framed the moment as potentially the greatest wave of trade liberalization in our lifetimes, everywhere else, a direct consequence of U.S. protectionism pushing Canada, Europe, and Asia toward each other. At the same time, the U.S. has flagged Canada in its annual trade barrier report for failing to enforce forced labor import prohibitions, a finding that analysts say could lead to additional 25% tariffs under the Section 301 investigation, covering 60 countries. The USMCA review is also approaching. Canada's pivot to China and Mercosur comes precisely as Washington is assembling new tariff pressure. The weight of evidence suggests Canada's near-term economic trajectory hinges on two sequential questions. First, whether the Iran ceasefire holds long enough to bring oil back below $100 and remove the BoC's rate hike pressure. Check the WTI price and BoC rate market pricing on April 29th. And second, whether the USMCA review produces escalation or de-escalation. If oil stabilizes and USMCA holds, the BoC holds, the loonie firms, and the global diversification play gains time. If either breaks, the BoC faces a forced choice between inflation control and growth support, and history suggests central banks in that position almost always move too late.